Last week was a tremendous week. And in Friday's video, we said, hey, tremendous weeks are great, but this is a particularly strong and tremendous week. So we're not going to expect the market to continue at this kind of momentum. And we're gonna hedge some of our positions. And that's exactly what we did. We decided to add a short that was going to benefit from some of our longs. We have many growth companies that I know a lot of people don't like growth, but we view over a longer term time horizon. And as Cathie Wood says, you really do have to annualize that. If you are investing for that kind of period, if you're not investing for short-term cash liquidity, and that is a different type of person than us true investors, not traders, necessarily living paycheck to paycheck over here, or at least living paycheck to paycheck, but having some savings. With those savings, you really do have to annualize backwards over, a 5-year time horizon, 3-year, 10-year, whatever it is. And we have some companies that right now are tremendously well priced. When you do that calculation, let's say 10 years out, it's a $10 billion company. Just a week ago, it was less than $1 billion. That's about 100% return per year. We have those companies we like, and we've been adding to those companies in the past few weeks. However, on Friday, I had to get a little more tactical rather than strategic and focus a little bit more on the short term and hedging myself against downside. So what did I do? I added a short that is in that growth bucket that I happen to not like. We're going to get to why we can do that because it's a different market environment, as this video is titled. But that position is WeWork. WeWork, I have fundamental reasons. And, balance sheet, I guess it's fundamental. But from a product perspective, from a market perspective, and from a financial perspective, I don't like the stock. So I'm shorting it. And as my Editas medicine goes up, my WeWork might go up. That might hit me in the short term. But we've had this big run. And today we're seeing a little bit of red in this growth category. Who knows if it's going to last? Who knows what's going to happen tomorrow? I don't know what's going to happen tomorrow. But I'm happy to add a short like that because one, gives me short-term protection. If the market goes down, if growth stocks pull back, I don't need to be too concerned because I have that short. In the long run, even if growth stocks go up in the short run, and that doesn't happen, what I just said, I'm convinced that stock is going down. So in the long run, which is how I'm playing, I will still see my gain. So it seems like a very well-calculated position. I also have SPY puts. Added a little bit to that earlier today. Not saying I'm seeing a big gain on that or anything, but that is, I'm protecting myself. Now, why am I protecting myself? Why is this market different? Well, for the last year, 2 years, up until November, let's call it, the Fed has been extremely accommodative, and they have extended that a little bit longer than they probably should have. What are we going to do about that? We can complain. We can, do whatever. Nothing we can do about that. We just got to deal with the cards we're dealt. So we've had a market that has moved at a tremendous positive trajectory. And it seems that positive trajectory is very much correlated to the expansion of the Fed's balance sheet and the Fed's accommodative policy. However, that is not occurring. And if you go back to 2000, 2001, etc., a lot of people want to make this comparison. I don't even think the market is the same as there. And I've heard on CNBC a bunch of people say, "Oh, you don't want to say this time is different." Well, this time is different because in that period of the previous dot-com bubble, what happened essentially at the peak, what caused the peak, was the first Fed rate hike. And you can look at the NASDAQ and say, all right, November is really when the market started projecting a more hawkish Fed. And lo and behold, the NASDAQ turned out. However, I don't think that's valid. Maybe, it impacted Apple, Amazon, Facebook, Netflix, Google, and they peaked then, Microsoft, etc. But those companies are not as extremely valued as the biggest players in the NASDAQ were in 2000. They are much more mature companies. They produce tremendous amounts of cash, and they actually trade at reasonable valuations, and they are still growing. So while they may be expensive, while they may see some of this 10-year, 20-year bond, safe haven flow a little bit out of that valuations, I don't think that's anything to get too worked up, too concerned about. I think that's just simply market dynamics. The stocks can't go up forever. A little bit of a correction, a little bit of a change in environment, that's okay. What's different though is how, we'll call it ARK, because there's so many components, so many stocks, so many people have so many exposures to various of these stocks. Some of them are not good, but some of them are tremendously good. That's been going on for over a year now. Very different than the prick of the first rate hike in 2000. And, if you look at Steve Cohen, if you really study Steve Cohen, Point72 history, he got that call right. You can see that the market initially ticked up when they hiked rates and then began to fall. This is a very telegraphed thing in history, and that was the popping of the dot-com bubble. As far as I'm aware, I was, 1 or 2 years old at the time, so I'm not going to say I know all history. But from my understanding, from my research, that is what occurred. And I think that didn't occur as much here because people had fear around that notion. I think stocks peaked out in January of 2021. Growth stocks, the stocks most vulnerable to this kind of move, peaked out earlier. And that's why I'm not as concerned about the hiking of rates right now. I am still concerned. I'm not saying we're going to new highs. The last video, Friday, it's still a very green day. I said, hey, new highs are not on the table. I'm going short some WeWork. I'm hedging myself here. I don't want to get out. But I want to hedge. I want to protect myself. And I think a short on WeWork is a good way to do that in addition to some SPY puts. So what does the market environment, in my opinion, look like going from here? Who knows, but I think it's going to be largely sideways. I think we're not going to hit new highs anytime soon. New lows, we were pretty extreme oversold. It was kind of like maximum bearishness. Everyone was fearful. So can we get there? Yes, if we see a worsening of various situations, which is entirely possible. The future is uncertain. But we're going to have to see fundamental negative environment news that comes that way. Let's just do a quick Nike just beat earnings tremendously and the stock's up. So, can we really be so bearish? Well, yeah, things can happen in the future, but earnings, the economy are still remaining strong. So we have to balance the two out. We can't get too in this category or too in this category. We kind of have to play a little bit of both sides and a little bit the long term and really just have proper portfolio management. And I think we can navigate the situation all right. I think we really can. If we first principle, focus on price. What's the price we're paying? What's the product we're getting? The product being stock, etc. And having a well-valued company in pretty much any environment, sure, you may experience a short-term downside. You should always be prepared for that. But if you buy it at a good price, it's a good price. I know it sounds tremendously simple, but that really is what it is. That's why Warren Buffett says it doesn't matter what your IQ is. He would rather pick someone who had good temperament but a lower IQ over someone with a higher IQ but worse temperament. It's an environment of temperament. Don't be buying at the top. Don't see a stock green and think you have to buy it. Don't worry about things that might affect your emotions or your temperament. This is a sideways market. This is a market of competing forces. This is not a Fed liquidity market. In fact, it's a Fed tightening market. So in that kind of environment, fundamentals are what matters. Not momentum, not liquidity. Are you happy to not have a market driven by liquidity? Didn't that always just kind of freak you out and not sit right in your mind? I know it felt right in your stomach because you were making money from it, but didn't that not feel right in your mind? I know it didn't feel right in my mind. I did not like thinking the market was driven by liquidity. Even if I wasn't actively, noticing that, I definitely did not like that. And here I am reiterating that point in a different environment, hoping to prepare you and hoping to continue to improve and prepare myself. So, fundamentals, price, cash flow, and or potential cash flow. We can't ignore growth. We can't say rates are rising, therefore sell all growth, okay? If it's cheap, if you can do the multiple, and you can prepare for additional downside, because unknowns, Fed tightening, we know that we have to take some additional risk right now for taking some growth. But if you can do all that calculation, don't ignore certain parts of the market just because other people told you to. Typically, if everyone's telling you to do something, you should not do it, in my opinion. I know that's super anecdotal, but that's just something I have to share with you. So that's today's video. And until next time, peace out.